Hey, welcome back to The Dive. Today we're chatting with David Bars from XOUT Capital. But before we begin, I'm just going to remind you to tap that subscribe button. Hey David, welcome back to The Dive.
Great to be here. Thanks for having me.
Okay, so let's start with AMC Theaters. They were supposed to raise money and then declined at the instance of an ape army, which is essentially a loud social media following online. Do you think it's irresponsible of management to not use this opportunity to raise money?
Well, look, AMC is a very specific situation where it's one of the MEMS stocks, right? There's been an uproar about it because of the attention it's received from some of the chat rooms and the promotion as a result thereof. And if you were a fundamentally driven, value-based investor, you continue to be sort of clueless as to how the stock has appreciated to the valuation that it's at currently. So is it irresponsible for a CEO to decline raising money with a scenario like that? Or is it responsible for him to say that if we looked back in the mirror from the future and he raised money at a valuation that was maybe not supported by fundamentals at the present time, that somehow he could be culpable for taking that capital when he knew things that the market might not know? So I could take both sides of this argument. Since you challenged me with one side, I took the other. But I think it's a stock that has very specific circumstances that seems to be really interesting to financial journalists.
So, what would AMC need to do to get included in the XOUT fund?
Well, it's not currently qualified because I don't think it is part of the constituent base. We select from the largest US equity market cap companies, the 500 largest. I don't think it is yet at the 500 largest. It might have appreciated in market cap value to get pretty close, but at the present time, it's not in our constituent base. So we thankfully don't have to address this issue for our own fund. XOUT really focuses on companies to exclude, not companies to include. We let the winners take care of themselves and we exclude the losers. I would say based upon the fundamental criteria that we use to evaluate securities, it's probably highly unlikely that AMC would get into our portfolio.
One of the companies for your top picks is Amazon. Now that Jeff Bezos stepped down, how do you see this change impacting the direction of the company?
Well, look, I think Jeff Bezos is an extraordinary corporate leader. What he was able to do and has done with that company is maybe unprecedented, and certainly his wealth is what a lot of people focus on. It proves that out. Um, but he has built a great company, and to have a great company, you have to have a lot of great people around. And I don't think there's going to be any kind of immediate change. It's something that we have to watch and see. We use a criteria called the management factor as one of the 7 criteria for evaluating securities to X out of our constituent base. And so we will be watching carefully how the new CEO performs and what kinds of changes, because there's likely to be some change. There has to be. Every leader brings some element of change when there's a new leader in place. So it's something to watch and see. I think there is a very high bar being set. And you kind of liken it a little bit to Apple. You know, when Steve Jobs stepped down and Tim Cook stepped in, there was a lot of questions about can Tim do the same job that Steve did? And I think we've seen as Apple has grown that a company is more than one individual, and their growth has continued to be outstanding. So I have a good feeling about Amazon's future.
Awesome. Okay, so we see Tesla as a top holding. It's hard for most people to wrap their heads around the valuation at this level. What's your argument for including them in your top 10?
Yeah, I mean, I can't argue with you on this one. It is a challenge. Tesla is evaluated just like all the other 500 securities are evaluated in our constituent base. As I said, we have 7 factors. Revenue growth is one of the important factors we use to evaluate a company. It has had some trouble of recent time in growing at the same rate it had grown. And so because we rebalance every quarter at XOUT, it's possible that notwithstanding the market cap weighting that Tesla gets in our portfolio, it could get X'd out. That's a possibility, quite frankly, for any stock in our portfolio. But Tesla is certainly one you point out, has some fairly hefty valuation that is starting to disconnect from fundamentals. And so who knows? But let's have me back on the show after July 15th when we do our rebalance, and I'll be able to tell you for sure.
So when technology crosses into the realm of important social issues, government entities often stop in and introduce regulations. How do you view the regulatory risk with big tech companies in this environment?
Yeah, it's interesting. In the last few months, one of the significant risks that I've been addressing for folks has been inflation and the rising interest rates, and whether that's transitory or here to stay. And that inflation risk had, in effect, caused a deflation of the valuations of many of the technology positions. I kept talking to people about how misplaced this was as a risk, but you have identified for me what is, I think, the most significant forward-facing risk we have, which is regulatory oversight, scrutiny, and potential change to impair the phenomenal growth that these mega tech companies have continued to accelerate with. So it is a challenge. It's something that we're seeing happening all the time. We can talk specifically about not our regulations, our being the United States of America's regulations, but rather Chinese regulations because of what happened this week with the listing on a U.S. exchange, right? Didi. We saw what happened when the Chinese regulators imposed regulation without preparation, without forward knowledge, and what happened to that security and the price of that security. So I would say to you that this is an important risk. We don't know what's going to happen, which is why it's a bigger risk. It's hard to evaluate what the regulatory agencies are going to do, other than they've been talking a lot about this. And so it's something to watch very carefully, listen very carefully, recognize how the management teams of these mega tech companies recognize this as an important risk, and it's why they're always willing to go back down before the U.S. Congress and get grilled because they have to. And so I would say to you that that is one of the significant things we think about all the time, but it's very hard to plan for it.
So what do you think other companies are missing in adapting to technological changes?
I think what most of the companies and their management teams don't appreciate is the speed and acceleration of what technological disruption is doing to their businesses. And we're not just talking about technology companies, we're talking about all businesses in all industries. And what the COVID-19 virus, I think, has done for folks is show how an event, an unprecedented event, an unknown event, came upon us, and look what it did to accelerate change in many businesses that had to adjust because of what that virus did to change our lives, right? To keep us at home, to stop us from doing things, to worry about a healthcare scare, and to accelerate the production of a vaccine to help cure us all. This was a phenomenal experience that transformed businesses and probably added a speed factor of multiples to changing and disrupting. And so what I think most management teams don't appreciate is how fast something like this can happen. And there will be another event. I don't know what it is, but there will be another event that will further accelerate change, and management teams will be behind the curve because they just can't get their brains around it. It's not because they're bad or good managers. It's just because their brains don't function with the appreciation of the speed of change.
What area of tech stocks do you think have the best shot of outperforming over the next decade?
Yeah, like I said, I think technological disruption is occurring in all industries, not just in the technology space. And so for me, every single business has an opportunity to address disruption, to try and change for it, and to try and be prepared for it and accelerate and excel through it. It's not a industry specific um, phenomena. I think it's across all sectors. That's why there are, 24 individual sectors in the S&P 500. I think all 24 of them have to face this risk, and it doesn't matter whether they're in the predominant sectors that we have an easier time Xing out, like utilities and energy and real estate and telecom. Those are tough businesses to continue to grow as there are all these technological entrepreneurial companies that are looking to disrupt those spaces. But even in that space, those companies have to work to prevent against disruption. And so what I'd say to you is the answer is it impacts everyone, and everyone needs to think about technological disruption risk. And those that do and do a better job at it are the ones that are excelling.
All right, absolutely. Well, thank you so much for joining us on the show today, David.
Thanks, Cassandra. Thanks for having me again.
Thanks so much for tuning in. I'll be back again tomorrow. But in the meantime, don't forget to like, subscribe, and share, please.